Hi, everyone. I'm Rick Bensignor, and welcome to this week's In the Know Trader Show. As an add-on to my weekly Tactical Trader Report newsletter for In the Know Trader clients, this weekly cast is meant to give examples of when and where institutional traders and portfolio managers are making trading and investment decisions that you generally won't find from models that the public typically has access to. Moreover, as Morgan Stanley's former chief market strategist, as well as the first to have taught behavioral finance theory at NYU, I combine the practical application of the academic theory with 38 years experience trading markets to bring in the know trader clients market insights not typically found elsewhere. So let's take a look at what's gone on in the last week. With markets having made a significant drop yesterday after last week having been the worst week of the year in S&P terms, it was down 2.2%. I'll show you my take on the SPX, and that's the only market I'll overlap with what we discussed in the weekly newsletter, and then also take a look at some individual stocks that are popularly owned. So as for some of you who may or may not be aware, in our weekly In the Know Trader Report, which is called the Tactical Trader Report, we never cover specific stocks, but rather much prefer to trade through ETFs, a much safer way for individual investors to trade markets. And certainly what's happened in the past week is glaring evidence of why you're better off in ETFs and avoiding some of the single stock risk. So besides reviewing the S&P, we'll look at a few of the FANG and down names along the way and some popularly traded names. So in order to contact me, if you like the content of the show, my email is rick@intheknowtrader.com. On the website, intheknowtrader.com, you can find out more. And last week, I spent a bunch of time adding into the website an entire media page. I've been doing quite a bit of public media presentations in the last couple of months, and I've put up virtually all the clips there. So they're all buttons that you can click under the media tab and see a whole bunch of interviews. Especially, I'd say, pay attention to the ones that come from realvision.com, which spend the bulk of them are about the mental game of trading. So in other words, how we incorporate psychology into deciphering what's going on in the market. Of course, we've posted several of these weekly casts from that are done through stock charts. So those are there too. Some TV appearances I've had. By the way, I'll next be on Fox Business TV with Maria Bartiromo the morning of Thursday, May 30th. And I think we've got a couple of other clips of things up there too. So definitely check out the website at thenowtrader.com. And then today, as I mentioned, we're going to take a look at the S&P and what, if anything, has changed during the rather precipitous decline that we've seen, but it's only come over the last 6 days. And the market's actually, S&P is up about 24 points this morning as we record this. And then again, we'll take a look at some popular stocks. What I've got lined up to talk about today are Apple, Microsoft, Amazon, Boeing, Bristol-Myers, Merck, McDonald's. Snap I threw in there just because you want to take a look at this since it's IPO'd and what it's done. And then a good consumer staple type name in Walmart. So that's what we've got lined up. So let's now switch to charts and take a look at what we see. So let's start off here with the S&P 500, the benchmark index for institutions on the street, certainly more so than any other benchmark. I know you will consistently hear folks on the TV business channels talking about what the Dow did, and despite the fact that those 30 names may make up a heck of a lot of what corporate America represents, the reality is it's not an index that's looked at by the institutional community. with no comparison at all, it's the S&P 500. And that's really what you should be paying attention to in a general sense of what's going on in the market. So that's what we focus on with my 38-year career on Wall Street. You know, it's always been about the S&P. And my career started back in the early 1980s, so I can tell you that even, you know, over that time, it's really, the Dow is just something that's mentioned because the public tends to look at it, but if you're listening to this show, I have to think that you are beyond the average listener in the public and that you're involved in the markets, and therefore you really want to pay attention to what the S&P is doing and saying. So here we look at a chart. On the left-hand side of the chart was the top made essentially, what was it, just about October 1st or so, give or take. Last year, we just slightly poked through that just around the turn going into May. And obviously then we've had the big sell-off. So fair to say that at least for the time being, we have a potential double top against all-time highs. And now we've sold off. And what I want you to kind of look at in this chart are a couple things here. This level here, the propulsion level, and propulsion is a model that was developed by Tom DeMark, and several of the models I use are come from his slew of indicators. I think he's got somewhere between 75 and 100 different indicators that are all trademarked. And again, these are used by institutions, and very few people in the public have access to these or want to pay for the cost of them, and therefore one of the things I enjoy doing most is sharing with you, because I have an entire institutional consulting business. So besides In the Know Trader, I also have Bensignor Investment Strategies, which is a consulting firm to hedge funds and long onlys and pension funds on the street. And so, you know, in order to run my business effectively, I pay for these models because they give me an exceptional clue about how institutions, where institutions, and when institutions are doing what they're doing. And generally, I want to be more on the side of what institutions are doing as compared to, let's say, the general public, and or looking at a basic technical analysis type of tools. So these are a little more sophisticated. Definitely, there's a learning curve to them. But to me, you know, I've been doing this. I've been using these models about. I think I'm up to this year is my 24th year using them, and there's definitely a learning curve. But I want to expose you to them and at least give you a sense of what they're suggesting. So the first thing here, this purple line is, if properly broken beneath, it would suggest that we could get down to this pink line at 27. We'll round it up and say 27.20. It has yet to properly do that. It could have gotten that signal today if we had opened lower and taken out yesterday's low of 28.01. It did not. The market gapped up today, so no valid new sell signal from this model. In other words, and this works on the laws of physics. It's basically measuring with a formula of the thrust down, getting through this propulsion level correctly, and then the implied secondary thrust to the next, what they would call the propulsion exhaustion level. Of more importance, or maybe perhaps they'll say in conjunction with the fact that this did not get a sell signal, is that 27.99, which is also part of a Tom DeMark model. That's this dotted red line that comes out from the lowest low in this 9 count up. Now, this 9 count up is called the setup. It's 9 consecutive price bars that the close is above the close from 4 bars earlier, often the beginning of a trend. So we're looking at this level as the beginning of the trend as compared to where perhaps most people would say either here or somewhere lower, but the most recent uptrend that tested all-time highs started here at 27.99. And yesterday's low got a point and a half from it, and now we've bounced 35 points or so. So this level is holding, and that's important because we identified for our clients that between this level here of 28.37 and 27.99 is where you'd want to do some buying on a pullback. So far, I can say at least that's working. And in order to change my mind that we still have somewhat of a downward move that we're in the midst of, but not necessarily over, is we would have to properly get above 28.59, which is the propulsion level up, meaning that if we have enough thrust to get through here, again, there's proper rules, so you can't simply look at a move through it, it's how you get through it, then that would suggest a move up to 29.17, the propulsion exhaustion signal on the upside. So right now, we still kind of have a downward bias. It's stopped where we expected it to, 27.99. And the other piece of this puzzle here is this setup count, which is on a 7 today. Now, often, in order to kill a setup count, in this case, one that's going down, I'd have to have any day in the next 2 days close above the close from 4 bars prior. So today that would mean bar 7 would reference bar 3's close. So unless we got up to 28.79, today's day is at 7 down. Tomorrow I'm going to reference versus bar 4's close of 28.71. And then what day? Let's see, Wednesday, Thursday. So on Thursday, bar 9 would be referencing bar 5's close, which is all the way up here. So unless we have a really significant comeback in the next few days, my guess is that we're going to have a 9 down. And that gives me, if we can get a 9 down, 9 consecutive days, closing less than the close from 4 bars earlier, gives me a better chance that we're at some type of near-term bottom, coupled with the fact that at least for now, 27.99 is holding. We're holding against the cloud support zone. These are things I'm looking at to potentially be further buying and thinking that perhaps we have an overdone initial reaction to the Trump tweet that came out 2 Sundays ago. Now, by the way, for institutional clients, we turn negative that Sunday night in our weekly report. The Trump tweet got me to go tactically negative, looking for a test of exactly where we've gone into between 28.37 and 27.99. So let's look at what happens if things get worse. Where's the next potential target? And to me, it's kind of this, let's circle it so we can see. It's kind of right in here. Let's call it 27.19 to look at this dotted red line, 27.10. So essentially a test here of the March low. And, it's very possible that if we look at this pattern here in March as February, March as a shoulder, and then this move into this year's highs and all-time highs as a potential head, we may in fact come down, kind of test that same area again and get one more rally back. And at that point, the cloud may be resistance. It looks like it would going forward. And then up in here, perhaps we have a safer sale. So that's at least what some of these key institutional models are suggesting, and what we're focusing on for in the no trader clients. That's my take on the S&P. Let's take a look at some individual names. And again, we don't do this in the no trader reports. We only trade ETFs, but I know this is a good way of kind of showing you what some of the models would suggest on individual names. And again, it's the type thing that if you trade individual names as compared to ETFs, you have the chance to make more money if you've got it right, because an individual name certainly would generally have higher beta than an ETF in the same group, let's say. But at the same time, you have far more single stock risk. A prime example of that is something like Apple. So here's the chart on Apple. This bottomed on a weekly, by the way, almost all the charts we'll look at here are weekly charts. Bottomed on a weekly 9. At the same time, the cloud's lagging line got right to the bottom of the cloud. That's the safest, easiest buy there is. As far as I'm concerned, the stop is the smallest that you can have in virtually any trade you put on. When you buy against a significant inflection point, your stop out is smaller than virtually any other trade you're going to put on. So you may lose 5 out of 10 times on a trade like this, but you'll lose small. And when you're right, you've caught the bottom, like this was. back in the December decline. Notice that the peak in Apple occurred both at the top of the weekly cloud, as well as the weekly propulsion exhaustion level. So it said if we got through this kind of teal colored line, we'd get to, well, I don't know, bluish green colored line, we'd get here to this brighter teal colored measured target. It's exactly where we got to. It coincidentally was at the high of where the weekly cloud was. And by the way, this level here at 214, which is about $1 or darn close to the exact high of the move, was there all the way back in December as an upside target. And that's one of the beauties of this model too, is this didn't just show up last minute. It's been saying since the December bottom, once we started moving up, that a move could measure up to this point. In addition to this, one of the things I want to tell you is if you were at my public presentation at the New York City Traders Expo in, I think it was March or early April, I don't know, I think it was March. I specifically said that anything north of 210 in Apple would be a difficult going, and that if you were long Apple, you'd want to lighten up into that zone. And that's from completely different model and fully incorporating behavioral finance into actual charts. You know, so behavioral finance is an academic theory about how and when and why people make investment decisions and the biases they have that affect those decisions. And what I've been able to do is actually take the academic theory and specifically bring it to the market. And give me one sec. I'm sorry. Just wanted to clear my throat. Bring it to the market and kind of incorporate this idea into how and when and why to make decisions where we do. So this to us was almost as easy as this was a buy. This was a sale north of 210 from both a variety of technical indicators as well as how we figured out where the market was anchored in Apple and where sellers would likely show up. Now Apple here at 150, almost 150, what is that, 157-ish, give or take. It's done, we're kind of sitting on a 38% retracement from the rally up back down here. So we've broken through initial support, and I would say that if Apple got down to near 170, that's two unrelated targets that both show up in the same place, and I've got it circled here. So I'd be more inclined to kind of be bullish and looking at Apple on the long side from that perspective down there. Obviously, a Supreme Court ruling against them yesterday hurt. They're one of the largest weightings in any of the indices that they're in. So, this is clearly putting pressure on the market. Let's take a look at Microsoft. Different feel and look to Microsoft. This thrust to new highs after the December decline. So whereas Apple, let's say, couldn't get back to what had been its all-time highs, Microsoft is in a much better technical position, less influenced by the Chinese news than some other names. And it's actually on first level support from the weekly cloud chart. So you can see it actually got a little bounce and, we're moving higher. Do I necessarily want to buy Microsoft up here? I'd say that if you're really aggressive and love this name longer term, and it's been, just take a look at this thing over time, it's just been a massive home run, then you nibble a little here. But what my only concern would be if we get a week or two that we close underneath this line, then it opens up the door to come down to the baseline. And right now the baseline is stagnant and has been for the last few weeks. But that will change depending upon if Microsoft makes new highs anytime soon, and or as we start dropping off price bars. In fact, we'd have to get down to 26 weeks ago. So let's see, half year from Christmas. This basically gets you to the end of June. So this level will stay the same down at 113-ish until the end of June, unless Microsoft makes a new high. Otherwise, you can, kind of look at this as a target price to get to give yourself some long exposure if you're interested in doing so. Let's move on to Amazon. So Amazon got close back to all-time highs on this recent peak. Notice that on a weekly chart, it peaked on a 9 count, 9 consecutive weeks, that the Friday close was greater than the Friday close from 4 weeks prior. That's often this turning point, and you can see we've done a turn, and then this week, we gapped down significantly. The key level to look at here on a short-term basis is the 1779 level or so. That is the propulsion momentum level. If it doesn't get through this properly, then that's kind of level. If it does break through properly, it targets all the way down at 1587 or so, where I have two different, the propulsion exhaustion level happens purely coincidentally to line up where the TDST line is. Again, that's the lowest low in the 9 count that started a full setup count that ended in a 9. So for right now, I'm kind of neutral. Amazon, from a pure trading perspective, may do some nibbling down here, would do some much heavier buying down here if we got there. Let's take a look at Boeing, because certainly this has been a name in the news that has, actually, I want to look at this chart first, and then we'll get to the other one. So here's a weekly chart of Boeing, and what I've done here, and this is something I had looked at from quite a while ago, go back to early part of 2018. We've got from here, in fact, I don't think we need the cloud in here. So here, we've got what looks like a textbook expanding diamond shape pattern, in the sense that we were making higher highs and lower lows. And this move pushed through the line that was connecting higher highs, but it did so with an exhaustion 13 and a 9 a few weeks later. So I caution people, we wrote about this at the time in my institutional newsletter, basically saying I'm not a buyer of this breakout. Then, of course, the bad news came out about the MAX 737s. The stock is tanked, went sideways for a while, and now is feeling more pressure. So we're back within this kind of diamond-shaped pattern. And the question becomes, because we had a false breakout to the upside, will it get a move all the way down here kind of towards the downside? Or was this the biggest piece to the diamond, in which case now we should have lower highs and higher lows, the exact opposite? So until we kind of see, how far down Boeing goes now, we can't yet determine where and if and when we would draw an uptrend line to see if that pattern holds true. That's the first thing I kind of notice when I look. And if I switch, we're still going to stay on a weekly chart, but now this one's annotated more with some of the models we use. So you can see RSI is getting oversold again. MACD is definitely went into a sell signal just about April 1st or so. So it would have gotten you into a sell at like 392-ish. Stock's down at 342 right now as we do this. And I want to show you a perspective that we didn't see on either of the two charts. I think it's this one. Let me see. No, it's another one coming up. So where's the level? If I was kind of trading this and thinking that this peak is a significant peak, then chances are I'm 5 weeks away from a 9 down. Again, 9 consecutive Fridays that the close is less than the close from 4 Fridays earlier. And that would, in fact, well, we don't know for sure if it would take out this low. But what I'm looking at, in fact, yesterday I was watching CNBC on the halftime show, and Kevin O'Leary from Shark Tank was on, and he's a frequent contributor to CNBC. And he was saying he knows this name inside and out, and that his level to get back in is 288. And I'm not sure what he used to come in, to come up with that. That is lower than, let's see, what's the low here? 292. So it's just a couple bucks underneath there. My level is more in the low 270s. And that is where also a special way of measuring Fibonacci numbers, again, not a common way at all, developed by Tom DeMark, would say that something near 272 is the place that you want to come in. That over time, this is a fantastic company, and it's essentially a gift to be able to get in at this level. Let's move on to Bristol-Myers, which is a drug name that's definitely had some trouble over the last couple of years. We are seeing some stabilization recently. So I want to show you this too, in the sense of, let me see, no, it's just a single chart, but this is the one I wanted to go back in time. And it's important doing this because even, you look at, you bring this up and you look at a 5-year chart and you kind of say, okay, I've got the perspective, possible head and shoulders top, could be trouble. But I also I want to look and see, we go back to 20 years and it also had a head and shoulders pattern that cracked. And it doesn't have one exact cracking point, but most of the lows kind of come into this level where I drew this green line, which is just about where we've bounced recently. So somewhere in around this 45-ish level, give or take, is pretty darn important long-term support, or at least what had been, the breakdown level in the past. And again, you've got a head and shoulders pattern. So the question is, does Bristol kind of hold in here or not? And I'm not sure. Again, I've seen people say that the Celgene buyout is accretive and should be ultimately good for Bristol. At the same time, when I look at this longer term chart, what I see is a heck of a lot of trading that's taken place in the last 20 years north of this green line. What I've seen is a heck of a lot of trading that took place kind of below this line. Again, not a specific level, but let's round numbers 35, and very little trading in between. And if we break under here, then we may very well spend a year or two into this range, or even get a spike low and come back. I'd want to watch it. But, in theory, if you, again, use behavioral finance here, you have a ton of trap a ton of trap sellers that had a lot of reason to why this pushed higher. So there is this zone that typically markets come back and kind of play with over time when they haven't traded there before. So Bristol, I don't really have, if you buy it, you have a pretty tight stop of $1 or $2, and then you could expect a fair amount of time that this could trade there. One last name I'm going to do is, let's do McDonald's because we're just about out of time. So look at McDonald's. We're basically on all-time highs. This has, been able to beat other markets and not be hurt by this China sell-off. However, I look at a weekly chart. I've got a 13 and 9 together. This is a name I might very well want to sell some upside calls if I've got. Because this would tell me, sell some upside calls at higher levels, pocket the premium, and if they take the stock from you, they do. This is suggesting near-term exhaustion. So again, just to finish things up here, best way to reach me is rick@intheknowtrader.com. Thanks for listening to our pod or webcast this week. I'm Rick Bensignor. Have a good day.